All right, let's just get straight into this explainer. Look, if you're a BS accountancy student grinding for the LECPA, you already know the struggle. Trying to retain taxation rules for 3 whole years of college? Yeah, it's basically like trying to hold water in your hands. That's exactly why today we're locking down corporate income taxation, specifically the core concepts from your Quiz 7. We're going to use active recall and visual chunking to hack your brain, so when you sit for the actual board exam, these answers are just going to click.
So we're building a mental memory palace today, hitting 6 major checkpoints: classifying taxpayers, the doing business test, cracking those RCIT rates, the OSD shortcut, dividend rules, and finally, a rapid-fire bullet review.
All right, checkpoint 1, classifying corporate taxpayers, the macro view.
You will literally can't calculate a tax rate until you know exactly who the BIR is taxing, right? So here's your first active recall test. Don't just wait for me to tell you, think about it. Which exact corporate entity gets taxed on its income from both within and without the Philippines? If a problem throws U.S. income and Manila income at you, who declares both?
Here's that rule of 3 chunking you gotta lock in. Domestic corporations, taxed globally, within and without. Resident foreign corporations, or RFCs, taxed locally, but only on their net income. And non-resident foreign corporations, the NRFCs, taxed locally as well. But here's the massive catch. They get taxed on their gross income, 0 deductions allowed.
The biggest takeaway here is the word domestic. It relies 100% on the laws under which the corporation was actually created. It has absolutely nothing to do with where the owners live or even where the main operations are. Created under Philippine law? Boom, it's a domestic corporation, and the BIR is coming for that worldwide income.
Moving right along to checkpoint 2, the doing business test, comparing active versus passive.
Okay, so we know what makes a domestic corporation. But foreign corporations, the Board of Accountancy loves to try and trip you up here by blurring the lines. It all comes down to contrast. Active commercial solicitation, like opening a branch office or having a hand in management, that makes a foreign entity an RFC. But what if it's just a passive investment, like they're just holding shares and collecting dividends? That keeps them squarely in the NRFC category.
Listen closely to this one, because if an exam question casually mentions a foreign company's agent staying in the Philippines for 180 days or more, or if they drop a hint about management control, your brain needs to instantly flag that as doing business. That 180-day rule, classic LECPA trap. The second that's triggered, they become an RFC, which means they're suddenly taxed on net income rather than gross.
Next up, checkpoint 3, cracking the RCIT rates, specifically 25% versus 20%.
Now for the numbers. This is the absolute core of the exam. But before we just dive into the matrix, see if you can pull this from memory. What are the 2 highly specific exceptions that pull the corporate tax rate down from the standard 25% to a sweet 20%? Hint, think about business size and think about special economic zones.
Check this out. It maps the standard 25% baseline right against those 2 20% exceptions. So, 25% is your default for general, domestic, and resident foreign corp. But you drop to 20% if you're an MSME, a micro, small, or medium enterprise, or if you're a registered business enterprise under the Create More Act. Let's break down exactly what that takes.
This is huge for your exams. To score that 20% MSMRE rate, the entity absolutely must be a domestic corporation. RFCs do not get this. Net taxable income has to be 5 million pesos or less, and total net assets can't exceed 100 million. But here is the ultimate study hack. Examiners will constantly try to trick you by tossing in the value of the land in that total asset number. Always subtract the land where the office or plant sits before you even look at that 100 million limit. The second way to get that 20% is the RBE exception. Thanks to the Create More Act, this rate is actually available to both DCs and RFCs, provided they are registered business enterprises using the Enhanced Deductions Regime, or EDR. If a problem mentions PISA, BOE, or the EDR, you immediately shift gears to 20%.
All right, checkpoint 4, OSD, also known as the 40% shortcut.
This right here is going to save you so much time on the test. When you see OSD in a question, the number 40 should just flash in your mind. It's a flat 40% deduction. But 40% of what exactly? For corporations, the optional standard deduction is strictly 40% of gross income, not gross sales, gross income. So gross sales minus cost of goods sold. Here's the beauty of it. If a corporation elects OSG, you literally ignore every single operating expense they list in the problem. They're going to try to distract you with salaries, office supplies, rent. Ignore all of it. Just take 40% off the gross income and you're good to go.
Moving to checkpoint 5, mastering dividend tax rules. This is easily one of the most testable areas, intercorporate dividends. When one corporation pays another, the BIR cares a lot about where that cash is actually going. Notice the stark contrast. If a domestic corporation pays out dividends to another domestic corp or even to a resident foreign corp, it is completely exempt from income tax. Why? Because the money is circulating within the Philippine economy. But the exact second that domestic money crosses the border to a non-resident foreign corp, bam, 25% final withholding tax.
Okay, but what if a domestic corporation gets a dividend from outside the country? Take a mental snapshot of these exact 3 steps. Usually, these are taxable, but they become fully exempt if 1. The DC owns at least 20% of the foreign corp for 2 straight uninterrupted years. 2. The dividend is totally reinvested back into Philippine operations. And 3. That reinvestment happens within the next taxable year. If a word problem shows they missed literally just one of those, the whole thing is taxable.
So let's flip it back to money leaving the Philippines. We just established that a dividend from a domestic corp to an NRFC gets hit with a 25% tax. But enter the tax-sparing rule. Under this rule, that final tax plunges from 25% to a flat 15%. But it's highly conditional. The NRFC's home country either has to allow a tax credit or completely exempt that dividend back home. The whole logic is just to spare them from getting crushed by double taxation. So if your exam mentions the country of domicile allows a tax credit, that is your giant neon sign to use 15% instead of 25%.
And finally, checkpoint 6, the LECPA Bullet Review. Let's synthesize all this into a high-yield cheat sheet you can visualize right before the proctor hands you the exam. These are the literal trigger words the Board of Accountancy uses. You see within and without, instantly think domestic corporation. 180 days, tag them as an RFC. Checking that 100 million asset limit, mentally cross out the land value on the page. See OSD? Draw a massive 40% next to the gross income and ignore the rest of the expenses. Lock these in, and you're absolutely hacking the exam.
I want you to really ponder this final question while you review your notes, because understanding how one single action, like an agent just stepping onto Philippine soil to manage a branch, can instantly morph a corporation from an NRFC taxed on gross income to an RFC taxed on net income, that is the absolute secret to mastering this subject. It's way more than just memorizing rates. It's understanding the underlying logic. Keep up that active recall, trust your notes, and you are absolutely going to crush Quiz 7 and the LSEPA. You've got this.